The Indian bond market has been witnessing increased retail interest of late, largely due to the subdued equity market, monetary easing, and increased geopolitical uncertainties. Long-end government securities or G-Secs are finding renewed interest among retail investors given the potential for capital appreciation in a falling rate environment. As rate cuts become more likely, investors are locking into higher yields before they decline further. Foreign investors ramped up purchases of Indian government bonds by 46 times last week, an indication that aggressive currency intervention by the central bank is building market confidence. Global funds bought 55.51 billion rupees or $631 million of debt accessible to foreigners last week, according to Clearing Corporation of India. The currency surged nearly 1% last Wednesday after the RBI went on the offensive against rupee bears. The RBI sees the rupee under speculative attack and is prepared to intervene further until it settles at a stronger level, according to people familiar with the matter. The RBI's intervention has lifted the rupee from near record lows and improved the returns on Indian bonds, which are on track to beat their emerging market peers for a second straight month. The 10-year yield is at around 6.5%, amongst the highest in the region. Yifei Ding, senior portfolio manager for fixed income at Invesco Hong Kong, spoke to Mint and said, given the relatively high yield levels offered by onshore rupee bonds, a steady or even appreciating rupee is certainly very positive news. A strong rupee will attract more investors into Indian government debt as they can benefit from the high carry gains from holding high yield assets. The rupee gained by the most in 4 months for the 5 days through Friday, as the central bank waded into both offshore and onshore markets. That's helped narrow the rupee's year-to-date losses against the dollar to 2.6%. However, rupee is still the worst performing Asian currency after the Indonesian rupiah. Rupee-denominated bonds have returned 1.9% to investors so far in October, compared with 0.2% for the broader Bloomberg gauge of local emerging market debt. Potential currency gains on top of relatively high yields continue to draw investors. While pressure from the US tariffs and the central bank keeping interest rates steady had pushed yields higher earlier, easing inflation and the prospect of monetary easing now offer fresh support for Indian debt. Yields on the benchmark 10-year bond eased 7 basis points this month after rising 25 basis points in the September quarter.